Welcome to Money Mode, the channel that makes money talk less confusing and way more useful. Let's get into it. Somewhere in a quiet meeting room, a handful of people vote on a single number. No cameras, no fanfare. Just a decision that changes how much your mortgage costs, how much your savings earn, and whether your job feels safe. That number is the interest rate set by the central bank, and it might be the most powerful tool touching your wallet that you've never really understood. Let's start simple. A central bank is like the referee of a country's money supply. It doesn't hand cash directly to people, but it controls how expensive it is for banks to borrow money. When the central bank raises interest rates, borrowing becomes more expensive everywhere. When it cuts rates, borrowing gets cheaper. That single decision ripples through nearly every corner of your financial life. Think about a rate hike first. When rates go up, banks charge more for loans. Your mortgage payment can climb even if you didn't buy a new house, because if you hold a variable rate loan, your monthly payment adjusts with the market. Credit card interest rates creep higher too, so carrying a balance becomes more punishing. Car loans, personal loans, and business loans all become pricier to take out. But it's not all bad news. Higher rates usually mean better returns on savings accounts, fixed deposits, and government bonds. Suddenly, parking your cash somewhere safe pays you more than it used to. That's the central bank's way of encouraging people to save instead of spend, which cools an overheating economy and helps tame inflation. Now flip it around. When the central bank cuts rates, borrowing gets cheaper. Mortgages become more affordable. Businesses take out loans to expand and hire, and consumers feel more confident spending money. This is usually done to stimulate a slowing economy, to get people spending and businesses investing again. But there's a trade-off. Your savings account might earn almost nothing, and cheap money floating around the economy can eventually push prices up, fueling inflation down the road. Here's where it gets personal. If you carry debt with a variable interest rate hikes hit you directly and quickly. Your monthly payments can jump within a single billing cycle. If you're a saver with little debt, rate hikes can actually work in your favor by boosting the interest you earn. Meanwhile, if you're planning to buy a home or take out a large loan, timing matters enormously, since borrowing when rates are low can save you an enormous amount over the life of a loan. Interest rate decisions also ripple far beyond individual wallets. Higher rates tend to strengthen a country's currency, making imported goods cheaper but making exports less competitive on the world stage. Stock markets often react nervously to rate hikes too, since companies face higher borrowing costs and investors shift money towards safer, interest-paying assets instead of stocks. That's why a single central bank announcement can send stock markets swinging in either direction within minutes. We saw a dramatic real-world example in the early 2020s. As inflation surged worldwide, central banks moved aggressively, hiking rates multiple times in rapid succession. Mortgage costs spiked. Savings account rates finally became attractive again after years of being nearly zero, and stock markets experienced sharp volatility as investors recalculated what companies were really worth in a higher rate world. So what can you actually do with this knowledge? First, know whether your debts have fixed or variable rates, because that tells you how exposed you are to rate changes. Second, when rates rise, consider whether it's finally worth moving idle cash into higher yield savings or fixed deposits. Third, before taking on new debt, pay attention to where interest rates are heading, not just where they sit today. And finally, remember that timing the market perfectly is nearly impossible. Building steady financial habits matters far more than reacting to every rate announcement. Central banks will keep raising and lowering rates as the economic cycle turns, sometimes several times in a single year. You can't control their decisions, but you can control how prepared you are for them. Understanding this one number, the interest rate, gives you a genuine edge in protecting and growing your money, long before the effects ever show up on your bank statement. This video is for educational purposes only and is not financial advice. If this helped you understand your money a little better, subscribe for more videos that break down finance in a simple, visual way.